Well, hard to say with any precision, but I think it's pretty simple to say that the dual mandate objectives of inflation and employment now are pretty close in balance, yet monetary policy is still quite restrictive. Most people think that neutral is somewhere between 3 and 4% on the federal funds rate. So call us, 150 basis points away from where we should be.
If we have a vector of whatever it is, economic growth, disinflation, whatever we draw up in our minds, Peter Orszag would call it a glide path. Which is the glide path right now that matters to Bill Dudley that says this Fed's got to get up and go?
Well, I think the main issue is the fact that when the labor market tends to deteriorate, it either tends to deteriorate a little or a lot. So you don't want to go past that threshold where the labor market starts to feed on itself and continue to worsen. That's why you want to take out insurance now by going more rapidly rather than going gradually.
So, Bill, in your Bloomberg Opinion piece today, you note that the two objectives of the Fed's dual mandate, that is price stability and maximum sustainable employment, that they've come into much closer balance, suggesting that monetary policy should be neutral. But we're pretty far from neutral. So how do we get to neutral, and how quickly do we do that, Bill?
Well, I think the reason why the Federal Reserve is going to do 50 basis points this week is to get there more quickly. Now, the good news is a lot of easing's already priced in over the next year and a half. So the market's priced in 250 basis points by the end of 2025. So it's not absolutely critical that they do 50 versus 25 today, but doing 25 would have been awkward because it would have disappointed market expectations. They probably would have shown only another 50 basis points in their summary of economic projections. So the Fed would be essentially saying we're only going to do 75 basis points this year when the market was priced for about 120. So I think doing 50 brings the Fed more in alignment with the market, and it also fits the logic of the moment.
Bill, do you have a concern or a reasonable concern that by maybe going slower than they should, that inflation gets back, recession gets pulled back onto the table?
Well, I think there's a risk of that. I mean, every time the unemployment rate has risen by more than 0.5% on a 3-month moving average basis over a 12-month period in the United States, you've always had a recession. We've actually hit that trigger. Now, I don't think that trigger is a hard and fast rule that has to hold every time, but it does tell you that when the labor market deterioration goes on beyond a certain point, it tends to become self-reinforcing. The next, stop after a 0.5% increase is 1.9 percentage points in a full-blown recession. So that's the risk the Fed's taking by waiting.
Hey, if the Fed only goes 25 basis points, do you think we'll get a dissenting vote there?
I would think so at this point. I mean, I think what's essentially happened is the Fed changed expectations last week with those two articles that came out in the Wall Street Journal and the Financial Times, sort of suspicious articles, because they basically reopened the possibility of 50 when that was sort of getting closed off. Since that time, we haven't had any, Fed intervention in any way that's visible. So it seems at least that the Fed is comfortable with the shift in expectations away from 25 to 50. So I don't think, as time passes, I think what's going to happen is we're going to continue to price more in the direction of 50.
Okay, I'm going to go nuts here. And, thanks. Marty emailed it. Marty, thank you so much for listening this morning.
On the 5th floor.
Bill, I'm sorry. We've got a shattered way of communicating. We have basically back X number of meetings, a dissent-free Fed. I mean, love, peace, love, and dope. I get it. We are the world. We are committing Fed policy and discussion through a reporter at the Journal. Who's the reporter at the FT?
I don't know.
Smith. Oh, Colby Smith.
Colby Smith.
Yeah, Colby Smith. Okay. Come on, Bill, this is baloney. How did we get here? Do you blame Alan Greenspan? Lawrence Meyer, Washington University, St. Louis, would say it was a term at the Fed where Alan read everything. Is that where this started, Bill Dudley?
I'm not really sure why we've landed where we've landed. I agree with you. This is sort of awkward. You really shouldn't be communicating through these sort of articles in such a subtle way that some people get it and some people don't. That doesn't seem to be very fair for people to get the right signal from the Fed. I think what basically happened was the issue of 25 versus 50 was getting sort of closed off as you approach the blackout period. Powell didn't want it to be closed off because he was actually thinking pretty strongly about 50 basis points. And this was the way to keep it open. And I think what's happened is people have reflected on it a bit more. The logic for 50 has become very compelling to people. And that's why I think that's what the Fed's going to do at this meeting this week.
I want to make a distinction here. This is not an Alan Meltzer 50. I mean, we're not showing up at the discount window because the world's falling apart. Is this like an original 50 beep cut that we're getting because of pandemic mysteries, because of unknowns, or frankly, Dr. Dudley, because of too much information?
Well, I think they're just started a little late. I mean, a month ago or so, I said that they should have cut rates in July. So if they'd done 25 in July and 25 in September, they'd be in the same place. So I think it's a little bit because the labor market has weakened more quickly than they were anticipating. Remember, we had those very large downward revisions to payroll employment. And then the last 3 months in terms of the payroll gains is the lowest 3-month period since 2020. So there's been a distinct chilling of the labor market, and that's happened fairly rapidly. Now, the Fed is, reasonably comfortable that that's mostly due to the fact that the labor force is increasing, and that's what's pushing up the unemployment rate. But there are quite a few signs that the labor market's a little softer than it was, and I think that's what's maybe surprised the Fed how quickly that's come on.
Is there, just following up on that labor point, Bill, is there a level of the unemployment rate, I don't know, a headline number that would really get their attention, or is this trend higher that you mentioned before, is that what's going to push this Fed forward?
Well, I think you're exactly right. The labor market holds the key here. So if the unemployment rate keeps drifting up, that will continue to motivate the Fed to go more quickly. Because at that point, the risk won't be balanced. The risk will be tilted to the downside on the labor market. So right now, think of the risk as balanced. We want to go to neutral. Labor market continues to deteriorate. Unemployment rate keeps going up. The Fed will then start to think, oh, we don't want to push policy to neutral. Right. we might want to push policy to easy.
Bill Dudley, you've got a key paragraph where you touch upon what Vice Chairman Claret has talked about and many others. Thrilled folks, the Fed decides on Wednesday. I can't believe it'll be better than the last time we did it 6 weeks ago, but we'll try. And the answer is, Dr. Dudley, is the vectors in place of, let's say, disinflation for conversation. But are we getting back to 2.0? Do you simply discard what I'm going to call a John Taylor 2.0 banded endpoint? Is there a new endpoint that jumbles up all of our thinking?
I think the Fed thinks that they're going to get back to something close to 2%. I mean, if you look at the labor market right now, for example, labor job openings are at a level consistent with where we were in 2019, where inflation was actually below 2%. The other thing that's sort of should make you more confident that is what's been happening to wage inflation. That's come down below 4%. So I think the Fed is not like giving up and saying, oh, 2.5% inflation is good enough. I think they do think that we'll see further disinflation in the months ahead.
So, Bill, we look at the 2-year Treasury. I mean, just a cup of coffee ago, as Tom would say, was it 5%? We're down to 3.55% on the 2-year Treasury. I mean, the market's already doing the hard work here, aren't they?
No, you're absolutely right. I mean, financial conditions have eased a lot, even though the Federal Reserve hasn't yet cut rates. And that obviously makes monetary policy work more quickly than it has in the past. Right. But that said, low and moderate income households, are affected by the current level of short-term rates in terms of credit card debt, auto debt. So the current level of short-term rates still matters a bit.
One of the great moments of my career, folks, and I'm sure Dr. Dudley doesn't remember this, we were at some whatever, the coffee was expensive and Bill Dudley was chowing down the croissants, as I remember. And we were talking about an America in the age of retirement, and Bill went mental, and full Goldman Sachs mental. And he said, Tom, some people have to retire at 60 because their bodies are broken. Bill, that was an indication of your work, your canonical work, which is there's two Americas out there. Are we committing monetary policy for the haves, the elite, the major financial system people that benefit from financialization, and this whole debate ignores an America essentially flat on their back?
Well, I actually think the primary motivation for the interest rates cuts is the deterioration for the low and moderate income workers. If you sort of think about the consumer spending reports we've gotten recently, it's all about stress at the low end, and I think that's what's motivating the Fed to cut rates more quickly. So I think they're definitely taking that into consideration.